Hello, everybody. Welcome to Friday, another Talk Money with Tom show. This is a live show that we do here from Silicon Valley to answer your questions about retirement and retirement planning, asset management, tax planning, all these things. We're just trying to help people have a better retirement, at least financially. And so obviously you can send in questions at any time. A couple ways to do that. You can send in an email right now if you'd like. You can send that during the week to this asktom@talkmoneywithtom.com. Or you can put it into the chat. We'll watch for that. We'll try to answer those live. So that's kind of fun. And really, again, we believe that the more you know about these subjects, the better you can do in your retirement. And I'll say this emphatically, as I've watched my clients throughout the years, the ones that are pretty good and knowledgeable about these things, even though they're using me as a resource or us as a resource, it still helps so much to know more. And so we created this channel, started this show. You can subscribe to this channel. You can hit the little bell button to get notified when we put new content on here. We are constantly putting out new information about this, these main areas. And so, of course, the other option, if you'd like, is just to meet with Ethan and I. You can go to our website. We have a really cool thing, a book appointment button. Our appointment schedule is on there, and you can set up a time to meet with Ethan and I, a 30-minute phone or video, and we'll be able to, answer your questions directly that way. So look forward to being able to help you today. We had some good questions that have come in. We had some questions that came in during some of our client, strategy sessions this week also that we'll cover too. So look forward to that. All right, we do always start off the show, though, with a conversation about the markets. We feel that understanding the investment markets is one of the three key pieces to your retirement, at least from a financial standpoint. You've got your retirement planning, as we'd have a really nice plan that you'd want to have set up. You've got your tax planning, trying to save money there. And then, of course, you've got your asset management. And so that's what this is about here, trying to get you to understand as much as possible, what's going on with the markets and, how to understand even the words, that come out all the time. So this is the S&P 500. This is this big index of 500 stocks, very popular worldwide. You can see I've actually charted this from the beginning of last year, which was the all-time high. We've had all this, run down, but very significantly, we broke through that red trend line, right? That's awesome. We actually had a great January, not so good February so far. Not to be unexpected. If you look at, where that bottomed out was actually back in December, that's a big run. We broke the 200-day moving average in that round. We broke the red trend line there. We had the 50-day moving average come through. We established a new high. I mean, a lot of things happened in that run. That was a very significant run. So to have it pull back, honestly, that's a pretty normal thing. So far, that's all we're doing right now. And if you look close enough, you can see it's pulled back to around 4,000 there. We spent a lot of time at around 4,000 so far over the last, few quarters. And so that's some support there. We'll see if it holds, right? And then we got another big support level there, about 3,800. So again, these are normal things. And actually, when you break through a big trend line like that, you can often see it pull all the way back down to that trend line before it does bounce again. So there's a lot of things to not worry about here, but there are some things to worry about, and so I'll show you what those are too. But in essence, that's what's going on right now. We're just trying to reestablish, we're hoping, a positive trend to the upside here and get back out of this downfall. But, so far we'll have to see what's going on. But this is this week, all right? So I think that's like the definition of the roller coaster ride. Yep. This is every 5 minutes, a chart kind of showing, And so you can see there were some big run-ups, both of which kind of gave back. But mostly it held up until today.
Yep.
And today, it's coming right down on top of my head here. And, today's down because of the inflation report that came out, right? And so let's look at those because this is really important. U.S. PCE, Price Index. YOY means year over year. So it means this January versus January of last year. And PCE stands for Personal Consumption Expenditure. This is a really important, everybody you talk to out there talks about CPI, right? Mm-hmm. CPI is not what the Federal Reserve is really focusing on. They are focusing on PCE. And CPI has gotten all the press, partly because it comes out earlier. It was on
2 weeks, too.
Yeah, about 2 weeks, because it was the 14th. It came out on Valentine's Day, which I thought was kind of ironic. But anyway, PCE is since 2012, the Federal Reserve has been using PCE as their main measure. It is a more comprehensive basket of goods, goods and services. It has a much higher representation of services, whereas CPI really doesn't. It looks at replacement things. So in other words, if bread gets too expensive, people stop buying bread, they might go buy something else. In CPI, they never make an adjustment. In PCE, they do. I mean, there's a whole bunch of reasons. So if you want to really understand investing and you really want to understand how the Federal Reserve is going to react, you really need to understand PCE. And again, so much emphasis is placed on CPI. When they talk about lowering, right, the inflation down to 2%, they're not talking about CPI. They're talking about core PCE, which I'll show you here in a minute. But you can see that problem we're having today and the reason it's coming down, it went up, right? Not a lot, a smidge. It's gone up before. This is the last year, still overall down. Life is not a straight line, yes, and either is inflation as it comes down. But direction scares the market, right? And maybe even the Federal Reserve. Now, if we take out food and energy, so the Federal Reserve doesn't look very aggressively at the what they call top line PCE here. They look at this core. So core PCE takes out food and energy. Well, you can see that's definitely not a straight line.
Yeah.
Right? It's had several bumps upward, even in the overall downward. If you look back a year, it's definitely lower. But we've had a pretty good jump in 1 month there, right? So that's, again, concerning. But even more concerning is if you look at it a different way, because they look at it year over year, this January versus last, and then they look at it month over month. January of this year versus December of last year, right? And so month over month, that's a pretty big jump.
Yeah.
So it's up 0.6%. And so it's been there before. Actually, if you look closely, this is the third time in the last year it's been at 0.6%. So again, market has broken through all these barriers and all these things have happened, even though those have happened in the past. But you're going to have a market that struggles in this environment. There's just no ifs, ands, or buts about it. And again, if I go back here to the year over year, 4.7%. When the Fed says we got to get to 2%, and then we're going to be happy and we're going to do the right things for the market and whatever they're planning on doing, they're talking about getting that 4.7 down to 2, right? PCE core. So the problem with the month over month is that if you take 0.6 and we had that every month for the next 12 months, not likely, but if it happened, you're actually at 7.2%, right?
Yeah.
12 times 0.6, 7.2. That's going to scare the market.
That's pretty much a disaster.
It is, actually. It's a pretty aggressively disastrous report in that regards. I talked about this last week from the Cleveland Fed does projections on PCE and CPI, and basically they're projecting upward motion on month over month, year over year, CPI, PCE, however you want to look at it. And so, that's what we're dealing with right now. And we saw retail sales were up 3% in January. So
Yeah.
it's probably reflective of this.
Yeah, and when you break it down, so PCE is kind of that mix of goods and services. Services, in December was 0.6, and again in January is 0.6. But it's really the difference was non-durable goods. That's where you had 0.8%.
Yeah. So and goods have been falling prior to this, and so goods and that's a little surprising because the Federal Reserve and Chairman Powell talks mostly goods are getting better. He used the word disinflation. And they're getting better, but services are our main concern because there's a tight labor market. We can't get enough people in there, and people are going out and it's shifted from buying goods to buying services like restaurants and hotels and flights and travel and those type of things. So to see non-durable goods, which are things that don't last, like
clothes, paper plates, cosmetics, things that we use up.
Yeah, exactly. Seeing that jump, not super surprising. That's probably where some of this, jump in retail sales went to in January. So maybe it backs off, but people are spending money. They're going out, they're borrowing if they have to, and that's not surprising. We've been talking about that for years as a possibility because the pandemic creates this pent-up demand. people got stuck at home, and the roaring 20s came out of the last pandemic. It's that same thing, and people just get going and start doing more things with their money and such too. So that's inflationary. And so again, just to be clear, this is what the Federal Reserve is worried about, is this number going up. And when the Federal Reserve worries, they raise rates. Mm-hmm. And so you can see the projection for where they're going to raise rates two places. One place is to look at the yield on the 2-year Treasury. And so I've got that blue line in there. And when it was going down, because inflation was getting better, really like last November, December, et cetera, the market was doing a lot better. Mm-hmm. It was kind of hanging in there, moving up, moving up, moving up. We broke through all those barriers based on that. But look at it now. I mean, it had a huge jump, broke through that trend line, but it's now at the high for this time period, around little over 4.8% is the yield. If you really want to understand the stock market, you have to understand also the bond market. And in this environment, the bond market's leading, because when we first saw some issues come out with inflation here over the last 2 or 3 weeks, the bond market rates started to go up right away, and the stock market went up too. That doesn't go together usually. Mm-hmm. Now the stock market's coming back down, so the bond market's leading. Watch the bond market. If you want to know what to do, it's one of the main triggers we use. I mean, we got defensive 2 weeks ago, right? Worked out really well for the most part because of that, at least with a portion of our portfolio, and we'll continue to do so. And then the last thing to look at here is just, what the futures market, what they call the swap market, is projecting for interest rates on the federal funds rate. So the Fed raises this Fed funds rate, and then it goes through to all these other things. Your mortgage is affected by it, credit card, your auto loan if you have one. And so that's now a little over 5.3%. And again, it jumped up quite a bit based on what's happening here. We had a fantastic job report in January, 517,000 jobs. We had a fantastic retail sales at 3.5%. And we got a bigger inflation number than expected, right? Those go together, right? People are getting jobs on whole, and they've got money to spend. So it's going on. It's a really interesting thing that's happening here. Again, we have a series of triggers that we use to decide when we're going to get more defensive. And so the first things that we get defensive on are inside of our IRAs and Roth IRAs and those types of things, because there's no taxes. And we'll wait a longer period of time for the taxable one accounts, because, if we take gains, we have to pay tax on it. And we try to avoid that as much as possible. However, you don't want to wait till the point you don't have any gains, right? So there's a kind of a balancing act there. But we're nearing some triggers on being some more aggressive on those positions. So, for example, we went into utilities, high dividend paying stocks, and energy in this last go round, and we're reaching some triggers that are saying, hey, although those are outperforming as a group, the overall market, because they've gone down less, they're not outperforming the T-bills, which are basically not going down. So that's a trigger that we're looking at there, and so we're going to continue to get more defensive if the market continues to fall. I wouldn't be surprised to see some deterioration from the market from here. There's been some damage already just in the last couple weeks, and then this report today was kind of a big deal, and so we'll see what happens, but we'll continue. We have a big capital preservation outlook here, even if it means giving up some to the upside. And we will continue to move pieces into more conservative areas, and we'll work on our taxable accounts and those types of things, as those triggers come through. But we try to stay in there as long as we possibly can. And we do have triggers to get back in very quickly, so that's good too. So we'll see how that works out. But anyway, that's what's going on so far with the investment arena this week. Not great news, but we're taking our steps to kind of protect everything, and I think everybody should be thinking about that here. I'm not saying the market's going to collapse or fall or turn into a 20% downturn, but I would not be surprised to see at least continued weakness here. So see how that goes. All right, so good. Thank you for watching this particular summary, and look forward to really covering this again next week.
Can you explain capital gains and losses, and does the IRS see a net of the gains and losses?
Yeah, so this is a question that came in. Can you explain capital gains and losses? And so there's lots of different types of losses, business loss and all these things. But in our particular case, you invest some money in in a stock, let's say, and it drops or it gains, right? And you sell it. There's some accounting to be done potentially. If it's in your IRA or your Roth IRA, nicely, you don't have to do anything about it. Those just get, you only have to deal with those upon withdrawal, right? So if I've got a taxable account and I'm going to take a gain, we do have a visual for this. Let me share that. All right, so let's just say there's two different types of gains, short-term and long-term. I guess there's four. There's a gain and a loss.
Yeah, yeah.
But those are kind of obvious. Short-term is something you've held for less than a year, and long-term is something you've held for more than a year. Simple enough. And so, again, this is one of the reasons that when we have a taxable account, we try to let them float for longer before we get defensive or deal with it, because we don't really want to generate short-term gains if possible, because there is a tax difference. Long-term gains are what I think the tax brackets are 0, 10%, 15%, 20%.
I think it's 15 and 20. There's no 10%.
No 10 now? Okay.
And then they have the 3.8
Oh, yeah. That,
additional tax.
the healthcare tax, exactly. And so it takes quite a bit of money to get into the 20% arena. So a lot of our clients end up in the 15% bracket, which is, it's not bad. And overall, ordinary income is how they handle the short-term gains. So it just becomes part of your ordinary income. And then it depends on what other income you have. And so we have an awful lot of clients that are going to say the 22%, 24%, even 32% bracket on their ordinary income, which is a lot more than 15.
Yep.
And so that's why you'd rather have a long-term gain than a short-term gain. Now, you can, and what they're talking about is netting out, right? And so we've got an example here. So the net of the short-term is
5,000 loss.
5,000 loss, okay? And so because we've got 5,000 gain, these are multiple transactions that happen during the year, and a $10,000 loss, you're out 5,000. The net on long-term gain is 8 minus 1 is $7,000. Yep. Now you can net those two out, okay? Short-term losses can be used against long-term gains. Awesome. Net gain is 2,000.
Yep.
However, if you reversed it, you couldn't do that. So in other words, long-term losses cannot offset short-term gains.
Yeah.
So for example, if I had a $1,000 long-term loss net, I couldn't write it off against my $5,000 short-term gain. So I have to have short-term losses against short-term gains, right? So, but short-term losses are valuable. You can use them for anything.
Yep.
And it's what they call tax loss harvesting, something we employ a lot to try to gather those, because you can also carry it forward. Yeah. And so that's the next example. Now we have a $1,000 capital gain on short term, same $10,000 loss, and a $5,000 long term gain, $3,000 loss. So you look at that, you got a $9,000 short term loss and a $2,000 long term gain. You can't offset those. You got a negative 7,000. So now what happens?
Well, you can use 3,000 of that to offset your ordinary income. So, but you're still left with $4,000 of capital gains. And so they have a carry forward rule, which allows you to carry that to the next tax year and then use it against future gains.
Yeah, exactly. So I mean, it's kind of nice. The 3,000, is right off your income. If you made 30,000, now you're making 27,000. I mean, basically, it's a write off. That's nice. But the other 4,000 then would have to be used against some type of gain. It can't go against that. Ordinary income is kind of money you make in a job, for example, whether that's a 1099 job or a W-2 job, those type of things. So there's lots of other ones, but that, for simple purposes. So now I can carry forward that $4,000 loss. And so that's why you want a tax loss harvest, because, and if you have something that you want to move out of, and it's at a loss, take it and gather it. And even if it's more than you need, you can use it year after year until you deplete it against future gain. So If you have like a $50,000 carry forward, that just means that you're going to be able to take $50,000 worth of gains in the future at zero tax.
Mm-hmm.
Terrible to lose 50,000, but it's a way to use it.
Yep.
And so you do have to be a little bit careful about gathering those short-term gains because they have a thing called the wash rule. And so if you sell, let's say, Apple at a $10,000 loss and then buy it back within the 30-day period, you no longer have a $10,000 loss. It gets wiped out.
Yeah, your basis just changes on that stock essentially.
That's right. And so that is not what you want to do. So you want to wait for that 31 days. And then there's other risks. Maybe Apple jumps and you could have had $20,000 during that period. So it's very difficult to do. Usually when we're doing tax loss harvesting, it's because we're going to something else. We're not going back into the same thing in 31 days. Once in a while, there's something that happens where we'll do that. But anyway, those are kind of I think the things that are important to know about this particular question.
I have an expiring term life policy. What should I do? How do I evaluate if I need another policy to replace it?
So term life just means that you have life insurance for a certain period. So 10 years, 5 years, 15, 20. The idea behind a term life policy is that you're trying to cover a term problem,
Yeah,
whatever that is.
Whatever risk you want to cover is going to go away eventually.
Yeah, you got little kids. You want to make sure that there's money there. Someday they're going to be big kids. Maybe they don't need as much money. Then you might get a 10 or 15-year policy or something or whatever.
Yeah, or you're 20 years away from retirement and you just
Right.
want to make sure that your family still replaces your income by having that life policy.
That's right. That's right. And so exactly, and you don't have the assets to maybe replace the income right now. So life insurance would bring in those assets upon your demise, right? And so also term insurance tends to be less expensive than what I would call permanent insurance. And there's a lot of different versions of that. And so what happens though is at the end of, let's say, that 10 or 15 or 20-year period, it expires, sort of. You can still keep it.
Yep.
At least in the cases I've seen, and I'm sure there's something out there that would refute that, but every case I've seen, there's some option to keep it. But they bring up the price pretty dramatically in order to keep it.
Yeah, essentially each year they give you a new premium that they reassess. Because they're not going to, but the nice thing is they're not checking your health. So,
Yeah.
So
If you're really sick and there's a possibility that you might pass away, and even though they're raising the cost per year, maybe double or more or whatever it is that you're paying, right?
yeah,
It probably might be worth it. In case something happens, it protects your family. That's probably the only scenario I can think of where it's worth it to pay because it's usually quite a bit more. Most of the times you're better off going out into the open market and just getting another 10-year policy or what have you.
yeah. The one thing that is are there underlying health issues that
Yeah.
will prevent you from getting a new policy?
That's right. And I mean, that's where it gets to be a bit of a catch-22. So, you developed cancer or something in that time frame, and maybe they don't. Maybe it's still going on, and nobody wants to cover you, or if they did, it would be ridiculously expensive. And so now your term insurance policy is expiring, but they're charging you a lot more too, and you can't get another policy if you let it drop. And so then it just becomes an issue of what are they charging you, and what are your needs?
Yeah.
Are the needs really there or not? Is it because sometimes these life insurance policies are sort of luxuries for a lot of our clients. They've got a lot of assets. So yeah, what to do with an expiring term life insurance policy? Essentially, the insurance company wants you to stop paying.
Yep.
And so they're raising that rate there. But there may be some situations where you want to keep paying. Most of the times, you're going to get a new policy or just let it drop.
So what would you be looking for to evaluate, do I need another policy?
Well, yeah, that's where you look at, pretty straightforward. You can do an estate plan and take a look at, 'cause I'm in the middle of that right now for myself. And just, I want to make sure there's liquidity there, because there's a house and all these things. And I don't want, them to have to sell that house. And, I think they get 9 months or whatever the number is. And so I want to provide liquidity for that situation from an estate standpoint. And that's a more of a permanent policy issue because, as it goes on for the rest of my life. So that's what you want to do. You want to analyze, why the policies need. Are you trying to cover mortgage? Are you trying to cover your kids? Are you trying to cover your shortfall in income if you pass away before you've built up your assets? All of these different types of things. That's what I'd be looking at to try to figure that out.
Yeah, and so if you're heading into retirement, maybe it's a mortgage that's going to be slowly declining, and so maybe you have 5-10 years left on that mortgage. Maybe you get a 5-10 year policy for that.
Yep.
Hopefully your kids are grown up and you don't need to be providing for them, but sometimes you want a small bit for liquidity's sake. Then you could get a smaller policy.
Right. And some of the smaller policies are a lot easier to qualify for, too. So, there's some options as far as that goes. But it's a good question. It's not an easy answer because it's extremely variable depending on the situation. And one thing you got to be really, really careful of, especially in our position, is telling somebody that they should discontinue a policy only to have maybe that person pass away and the spouse realizing, well, if we just kept it for another few months or whatever, I would have gotten X amount of dollars. So do be careful with this analysis, that's for sure.
Yeah, also sometimes even though it's a money thing, there's some psychological and peace of mind that you have to consider too.
Sure.
That's at expense.
Peace of mind's critical. We spend lots of money on peace of mind and trying to, mental health, and that's what vacations are. They're not free either, So to me, insurance as a whole is sort of like vacation in a weird sense that just makes me feel a little bit better and secure about the situation, either for myself or for my family if I'm not here, whether it's life insurance or car insurance or earthquake insurance or whatever. All of those you have to do a little calculation to figure out what it's worth, but they all bring some potential peace of mind. So that's what's important too. All right, what's our next question?
What are cyclical, defensive, and sensitive stocks?
All right, so that's a good question. Actually, we have a visual for that. All right, so here, this is from Morningstar, just their breakdown of those three categories. And so cyclical stocks are really things that would respond to a recession or a boom, right? They kind of, those are the two extremes, but the economy's growing, then cyclical is going to do well, theoretically. Basic materials, there's more materials being used because people are building, doing different things, Consumer cyclicals like cars and things that are,
Luxury goods.
Luxury goods, yeah, exactly, are going to do better when things are hopping, right? Financial services, that's us. Things do better and worse in a recession, right? So that piece. And then defensive is just things that, they don't do as well, relative speaking, in an up market. So, for example, utilities, which is on there. We just bought utilities. Yesterday's a good example. Utilities didn't do as well as the market. It was up. They were up, but they weren't up as much, right? Versus today, market's down a bunch, and the two utility pieces we have are actually up. So it's because these are things that people need. Consumer defensive, think toilet paper, right? I mean, that, right?
Yep.
There are things that people would need, healthcare, irregardless of what's happening with the economy. And so they tend to do better in downward markets. And so these are the types of things you would look at, since the beginning of 2022 would have done okay, right? And so I think, that's an interesting category right now to be speaking about. However, long term, you might make money in other areas because of what's happening, but certainly something. Then sensitive, this is kind of weird. They're just sensitive to different inputs. So like energy is a good example. There's a myriad of inputs that come into energy. It's crazy. It's a really wild market. Technology is sensitive to interest rates. We've seen that for sure because they're high priced. And when you're looking at higher interest rates, basically the discounting mechanism to get back to that price means a lower price. And so when rates come up, you'll see technology, and that's certainly been true, in 2022. And so they're all different, and they all have different kind of situations that they do well in, other situations that they do poorly in. And I do think it's important to understand those relationships. Matter of fact, for me, I call it the neural network. It's how are all these things connected? And understanding how things are connected is a never-ending game in
Yep.
this business, and that's fun to me. I think it's really fascinating. How is a pandemic connected? That's a new one. At least in the last 3 years, how does that affect things? What gets affected? And who knew that people are going to be buying Peloton bikes? Left and right. That kind of thing. That. So these are all understanding kind of these categories helps you to start to understand some of the connections that are happening in the markets. So when you see something happen, oh, interest rates are going up, maybe I should be lightening up on my technology stocks and looking at healthcare and utilities, that kind of thing, as far as that goes. And utilities are maybe, healthcare would probably be a better example of what to use. Utilities can be kind of interest rate sensitive sometimes too, but we still need utilities, irregardless of what happens with, the interest rates or the economy.
Yeah, you can kind of think of elective versus non-elective.
Yeah, exactly.
You
That's a good
know,
point.
I can skip on the iPhone, but I
Right.
will probably still need to pay for my phone bill.
Yeah, exactly. And you probably still need power to plug it into to recharge it in some form or fashion. So yeah, that's what makes it, durable as far as that goes, right? So, good question. All right, what's our next question?
With Intel cutting their dividend, should I be worried about other companies following suit?
Yeah, this is something really fascinating. I've had so many conversations over the years about dividends and dividend-paying stocks, which I have no real problem with whatsoever. But you see people get really excited. Oh, that's paying a 7 or an 8 or 9% dividend, and then all of a sudden they're cutting it, and it's because most of the times that happens, including with Intel, the prices come down. So let's just say Intel used to pay a 2% dividend. The price comes down because they're underperforming, as a business, and the dividend's now up to 6%. I'm making these numbers up, and Intel look at that and say, well, we don't really need to pay 6%, and we're underperforming as a business. We kind of need that money that we're paying out as a dividend to reinvest back into, in their particular case, probably new plants. Because they're starting to trying to open up plant. Their big one they're going to do in Ohio, I believe. And so, a classic example is GE, which had a fantastic dividend history for a long time. It was one of the original Dow components, going back to 1830. And GE dropped 90% in price, right, over a period of, 3 or 4 years, I think. And for a variety of reasons. But the dividend finally started getting cut and cut and cut and cut. And so, if you have a big dividend stock, there's no guarantee that it's going to continue to pay that. And so that's where you got to stay diversified if you can. I've got some clients with some really big positions in some companies that pay pretty decent dividends, and their capital gain is ridiculous. And so they're kind of stuck in that stock from that standpoint, and really at the whims of the company as to whether they're going to continue to be able to pay that same dividend rate.
Yeah, it's left to the market to decide.
Yeah, and that's where, you can do a basket of stocks, a bunch of different stocks inside of a ETF. They have a whole bunch of dividend achiever ETFs and all these different types of things. I guess the one thing I would caution about just in general, besides the fact that they can cut them, because that really was driven home in 2008. All these people had great dividends, and then when the economy fell apart, these companies didn't want to pay the money out, and they cut dividends, a lot of them. And so, it's not as safe and secure as an income source as you might think. But the part that worries me sometimes is, AT&T is a good example. I remember, I think it dropped like 40%. Yeah, I was paying a 7% dividend, but you just lost 40% on the price. So watch out. It's not a bank account thing. It's not a CD that doesn't have a variation in the price. It's an individual stock. And if that stock's paying a high dividend, why? Ask yourself why. And whether that's just their thing, is what they do, they've been doing it forever, or they got in trouble and now their dividend's up. That's the ones that are most likely, because AT&T actually did cut their dividend, eventually. So, it happens as far as that goes. All right, that's a good question. What's our next question?
Is it better to do a 5-year election or spread it across 5 years for funding 529 through gifting? And so a 5-year election is you basically take 5 years of gifting and put it into one gift or one funding. And so that's 85,000 for 2023 versus, or you could do 17,000 per year.
Okay, so I can put, and now I can only do this the first time, correct? I can't, can I do it every 5 years?
You can do it every 5
Every
years.
5 years, okay. So I have a choice of every 5 years putting in 85,000 or whatever the new number is, because they do increase
Yeah,
it.
it gets changed.
Or in this particular case, 17,000 a year over the next 5 years. You know, do you have 85,000? If you do, is it all of your money or just a pittance? Right? So how much is that to you? Because that matters. You know, I know that we want to fund our college educations, and those are really critical. But you also need other things. There's all kinds of things going on. So
Your retirement will always come,
Right.
should be a priority over more short.
well, yeah, your mortgage or whatever it might be. You know, you never know where things are going to go, and you might need that 85,000. And you can still get it out of those 529s, but you're going to have to pay a penalty and all kinds of problems with it. So generally speaking, you want to put it in. So let's just say, for example, that that's not a problem. You have 85,000. It's free and clear, no issues. So the next question would be, you know, okay, should I be putting 85 in now? Or should I be doing it, you know, every year? I would be looking at the market. Oh, hey, look at that. We just hit an all-time high a month ago. I might be doing the 17,000 a year in that situation. Or, hey, we just came down 28%. That might be a decent time to put in the 85,000. Or, you know, you can combine them too, obviously. Well, actually, I forgot about the rules about that, how they do like a 2 or 3 or half year. But
Yeah.
so the market timing would factor into that as far as that goes. And I had some clients that were basically in competition with the other grandparents. So they put in, you know, the max, and so they were going to put in the max. It didn't matter what happened with the market. So, and that's okay too. Good for the grandkid.
Yeah, and when you think about it, usually for this, if you're starting at the very beginning, usually when you do this kind of 5-year election, it's the very start of this child's life. And so you have 18 years. And so usually you have a lot of leeway with that.
That's right. That would be ideal, right? You know, it's so incredibly powerful to start these things really early, and we're seeing more and more of that, and people really starting to understand the 529. It's not new, but it's still bubbling up into the people's consciousness as to what to use. It's at least in my opinion, it's the best college savings vehicle, and so yeah, we have quite a few of them that we've set up, and I really like them. They're kind of weird. You have to set them up through a state. It doesn't have to be the state that you're in, so you can kind of choose. They can be a little bit expensive, but they grow tax-free as long as you're taking the money out for approved college or
K through 12 now.
K through 12. Private school, those are limited too, but and you can only make transitions in the portfolio every 6 months, you know, that kind of stuff. So there's a few weird things about them, but they're still really, really powerful vehicle, I think.
And depending on what state you are, there's also some tax benefits. Some states allow you to write them against state income tax.
Yeah, I remember a couple of years ago when the maximum was 15,000. Had a client in Pennsylvania who wanted to do 529, and they were going to get a $15,000 write-off for putting that money in there, which is pretty cool. Versus, you know, our situation here in California, that's not true. You don't get a write-off for the 529, which is too bad. It should be across the board, but every state has their own plan, their own process. All right, what's the next question?
What are my options for an inherited property?
Ooh, so inherited property, you can live in it, right? You could sell it. You could rent it. So let's just talk about those, starting with rent. All right, so if you're going to rent it, you got to think about the things that, you know, that you have to deal with the rental in general. How much does it cost to fix it up?
Yeah, is it a rentable shape right now, or do you have to put in 50, 100,000, whatever you need to put in to make it that shape?
Yeah, and then so if there's a cost up front, then how fast am I going to make that back? So what is my net rent after I have, you know, paid for all the different property taxes and insurance, and if I'm going to not manage it myself, a property manager, and what rent am I going to get? I'm going to spend 100,000 and get back 1,000 a month. I'm 100 months away from getting my 100,000 back. You know, whatever it might be. So you got to think about that. It's an investment, and it could be a great investment, especially, you know, if you keep it for long enough. And certainly, a lot of the people do here. And so it really, but it is regional. Yeah, I mean, you know, there are parts of the country where, you know, owning property isn't like owning property here. That's for sure. As a matter of fact, it's kind of stunning to me. But So then the next thing would be to sell it. So if you sell it, the big advantage to selling it is that there is a step up in cost basis. So mom and dad bought this place for $100,000. It's now worth $2 million or more, here in the area. And so, if you sold it, there'd be this big gain and what have you. But when mom and dad passed away, when the second one passed away, they got a step up in basis for you if you're the beneficiary. And so now I got a $2 million basis, not $100,000. And I'm simplifying this, believe me. But I can sell it without much tax at all, right? And so that's kind of nice. Now, I guess one of the disadvantages is you have 4 out of 5 people that inherit money, it's gone in 5 years. So you basically just made that easier to happen.
Yep.
You took
You
$2
get that lump
million that
sum
was
out.
locked into this house that you could have rented or lived in, and you took it out as cash, and there's lots of things you could do with it, so the temptation's there. And so sometimes you kind of have to do that because there's multiple beneficiaries.
Yeah.
And one of them there are 4 beneficiaries. One of them wants to sell. You got to figure out how to buy them out. Maybe there's other assets. Maybe you don't have the money. Maybe it's all in the house. So you kind of have to sell it. So there's things that happen where you have to sell it. But I would be a little bit careful about that whole, money disappearing concept too, as far as that goes. And of course, the last thing is to live in it. And you're kind of the expert on the Prop 19 pieces here for California.
Yeah, so with Prop 19, so let's say you inherit a California house. If it was your parents' primary residence, so if it's not a primary residence, this does not apply, which is a big issue. So it's their primary residence. You would have, let's say their basis was $500,000. You would be able to jump that basis up to $1.5 million and be still tax free. So you could transfer it up for property taxes. You would still have that. The nice thing is this only affects property tax and not the actual capital gains basis for your taxes.
Yeah. Yeah, and this is all new as part of this prop that nobody likes except for realtors apparently.
Yep.
My clients are really pissed off about it as a whole. They get quite violent actually. It's kind of interesting, but nonetheless, so there's some pros and cons to just living in the place also. So it's a good question. There's a lot of different options there. I think, there's enough good options amongst those options that you probably can find something that works. And it's a pretty good situation to inherit some property in today's world with the way the tax laws work and everything too. So
yeah, you have to evaluate your situation, what you're willing to do, what effort you're willing to put in to get that money, and then are you willing to move too?
Yep, exactly. All right. Well, that's our show for today. I want to thank everybody so much for coming. I'm really excited that you were able to join us today. Some great questions that came in here. Think about some other ones. Send them to us. Send them to asktom@talkmoneywithtom.com. We'll be here again next Friday. Be happy to kind of go through those questions and answer them. Of course, you can subscribe to our channel here at talkmoneywithtom.com. You can, hit the bell button if you want to get notified. Or you can set an appointment. Go to our website. There's a link to the website right there, and set up a 30-minute time with Ethan or I, and we'll be happy to chat with you about your specific questions. So, thank you very much for coming today. Really look forward to seeing you again next week.